welcome to the 2021 Investment Outlook for Pathfinder Wealth Consulting. I'm Jason Wheeler, if I haven't met you before, and I appreciate you tuning in. This year, the title of our presentation is On the Road to the New Normal. Now, if you've been around for many years, you know that we talked about the new normal after the Great Recession in 07-08. And here we are again talking about a new normal. The presentation will follow the same format. We always talk about where we've been. In this situation, we'll be talking about last year. Then we'll talk a bit about where we are today. And then finally, we'll talk about the future and where we may be heading. And as always, we appreciate your business for those of you who are clients. We appreciate your loyalty. And again, we appreciate you being there for us in 2020, and we hope we have reciprocated that well. If you have any questions, please let me know after the presentation. You can certainly send an email. You can call the office. Anything you need, we're here for you. So again, please enjoy the presentation and have a great 2021. Investment Outlook 2021, on the road to a new normal. Here's a brief disclosure slide that talks about risks of investing. As we know, there are many different types of risk, and we're here to help you sort through those risks and let you know which ones you need to take on and which ones you can mitigate. Also, to mention that this is our opinion, and our opinion does change based on the data that we receive. And so anything that we say here today could be very different in another 2 weeks, but that's the way it is in our world, and we just wanted to make sure we had our disclosure statement. Again, the format is where we've been, where we are now, where we may be going. So let's get started, but first we need a quiz to make sure you're awake. For the first question in our quiz, what was the Merriam-Webster's 2020 word of the year? And you can see the 4 choices here: coronavirus, COVID-19, pandemic, or schadenfreude. Every year they come out with a statistical analysis of the words most frequently looked up, and far more often than they were in any previous years. So this year, the word of the year is pandemic, an outbreak of a disease that occurs over a wide geographic area. I think we all know that this word is very popular, not only in the media, but in our daily lives as we talk about what we're going through together. 2020 was also a year of self-discovery. SAS Emily Gold wrote in The Atlantic, "One exciting thing about being alive at this pivotal moment in history is that I'm constantly learning about strong opinions I didn't previously know I had." What was she writing about? Virtual school, bread recipes, remote work, or pandemic dating? If you said virtual school, you got it right. And her quote, as she was talking specifically about her pre-kindergartner: "My hatred comes rather from having coached my 5-year-old son Rafi through virtual schooling in the spring. To say that virtual pre-K didn't go well would be an understatement. On one day, Rafi cried, screamed, hit his parents, hit his brother, broke things, and spat a cup of juice all over my laptop. Eventually, we scaled back to requiring that Rafi scrawl his name in a few letters and numbers before heading out to the park in the morning." And I think we could see that very often in the workforce today. I know we've seen some here in the office. There was one meeting where John Zachary had a cat on his head, and he had a toddler and a kindergartner all running around the room as we were trying to have a team meeting. Last question in the quiz: which of these shows was watched the most in 2020? Was it Lock and Key, Queen's Gambit, Space Force, or Tiger King? And if you guessed Tiger King, you got it right. It took the blue ribbon for the most watched. So now let's shift gears and talk about where we've been. So let's start our look at 2020 talking about the economy. If you think about the U.S. economy as a semi-trailer truck, no one likes being stuck behind a big tractor trailer going uphill, or particularly at a stoplight, because those big trucks don't go from 0 to 60 in 2.5 seconds. Well, neither does our U.S. economy. In 2020, COVID-19 pandemic brought our economy and other economies around the world to a virtual standstill. Now, the U.S. government and Federal Reserve took extraordinary measures to help the economy. They passed the CARES Act stimulus, which gave Americans and American businesses badly needed fuel. The businesses were able to stay open in many situations, and people also had money in their pocket to spend. And that's important because consumer spending accounts for almost 70% of our U.S. economic growth. The Federal Reserve smooth the road ahead by pushing money into the economy, and they were buying bonds. And they kept rates near zero, and they actually made the promise to buy unlimited amounts of government bonds going forward. And they even started buying corporate bonds. And they said they would buy junk bonds even if they needed to, but they didn't have to get to that point. So then the U.S. economy started gaining momentum. As you can see here in the slide, after the drop, it started to pick back up. And this is through the third quarter of 2020. So through the first quarter, when it arrived, people hunkered down, businesses closed, government stimulus and central bank policies helped the American economy get going again. The recovery was gaining momentum, just like a semi pulling away from that stoplight, as we had flattened the curve on the virus and states began to reopen. Then a new wave of the virus hit. So the number of cases started increasing around the world. In the US, we saw the number of new cases increase significantly in November. Hospitals became overwhelmed. Congress was unable to agree on a new stimulus package until late in December, when the economy was actually beginning to falter again. Reopenings became reclosings. States began to issue stay-at-home orders, and Americans became reluctant to travel. They were eating in restaurants or spending time inside public places of any kind of way because they were fearful of catching the virus. The slowdown in demand then caused businesses to hire fewer workers. So we obviously had a giant drop off in unemployment, and we started to see employment gains begin to creep up again. But then in November and December, they started to stall out, as this slide will show you. And of course, here's unemployment now. As you would guess, unemployment rates remain elevated. So we've cited in the monthly unemployment report, which is the U3, is the dark blue bar, reached 6.7 in November and stayed there in December. The U6 rate, the lighter blue bar, which includes discouraged workers who stopped looking for work and people who are working part-time because they can't find full-time work, that moves slightly lower from 12% to 11.7%. So again, you can see the recovery April, May, June, July, and then when you get to November and December, it really has stalled out. But fortunately, on this next slide, which shows you that consumers were still spending. The good old American consumer. Don't bet against them. And these high levels of unemployment, you would think that people weren't spending, but we were. And personal consumption through November, which is what we have the data for, drives economic growth. In 2019, again, it was almost 70% of our growth. The blue line was below previous year's level. So the blue line is the overall growth. It was negative 1.3% year over year. The red line, though, shows spending on services. And that's things like haircuts, restaurants, bars, manicures, and that was down almost 7% year over year in November. The purple line, which is positive, is non-durable goods. Things like PPEs, masks, gloves, gowns are included in there, and that was up almost 4% through October. And then durable goods, automobiles, freezers, home furnishings, that was actually where we saw the biggest gain. That was up about 13% as people hunkered down and stayed at home and wanted to do things around the house. In a year like this one, it's important to think carefully about statistics, though. For example, an expert could say consumer spending was up 15%, and they'd be right, as long as they were talking about just the durable goods. Overall, in November 2020, spending was still down compared to the previous year, but it was a whole lot better than we thought it would be back in the height of the pandemic. And as I mentioned, statistics tell stories, but they can also be misleading. In this one, it shows the first 2 quarters of 2020 as the economy started to falter. And then the third quarter, we finally began to grow again. And if you compare to quarter over quarter, which is the blue line, the percent change from the second quarter to the third quarter was up 7.5%. But that's really not the whole story, right? So if you think about it, if you compare it for year over year, GDP was still down. And I think that's a more accurate way of thinking about it. So the same thing with when you think about corporate earnings as well. At the end of the first quarter that we're going to be ending this quarter, we will have been 1 year from basically the bottom of the stock market, but another quarter until we're the bottom of the earnings cycle. And of course, in November, anxiety levels were rising because this was the resurgence of the virus. And as you see here, people are more stressed about their finances than they've been since the summer. And you can see some of the statistics I put here. 22% house debt household debt was rising. 46% were worried about job security. 15% found it harder to pay rent and mortgage. 47% were worried about paying bills. And again, this is in November, as they were worried about the rise of the virus again. And if they were all investors, their worries may have been somewhat relieved by the performance of the stock market, though. So let's shift gears and talk about the stock market. The U.S. stock market sped past the economy. So if the U.S. economy is a semi-truck, the American stock market was a sports car last year. In 12 months, we experienced the end of the longest U.S. bull market in history, coming from the 2008 and 9 Great Recession. And of course, we had the shortest bear market in history because the market dropped about 32% in March, and then it began to recover and actually hit all-time highs afterwards. U.S. stock markets, though, did have its fair share of volatility, and the black line here shows that. So the black line is the S&P 500, and it had the big sharp downturn early in the pandemic, and then it came roaring back. Purple line is the Chicago Board of Options Exchange Volatility Index, also known as the VIX. And it's really Wall Street's gauge for fear. And so some people call it the fear gauge. It reflects investors' thoughts about how volatile stocks will be in the upcoming 30 days. And so you can probably spot this relationship pretty easily. It obviously went the opposite direction. So again, it's what's the next 30 days going to be like, is what the VIX really shows us. So in 2020, when investors were worried about what might be ahead, the S&P tended to lose value. When they started getting optimistic again about what might be ahead, the S&P index started to trend higher. And it does illustrate an important fact about stock markets and helps explain why they did well last year, even though the economy was contracting, which we heard a lot. Because the stock market is always forward-looking, its performance reflects what investors expect for the future and not where we are today. But let's be honest, volatility is not fun. We always say you have to make sure you have your seatbelt on when you get in a plane, and you don't get off the plane when you hit some turbulence. The same thing with the stock market. Turbulence is not fun, but let's put it in context here. This volatility, there were 109 days when the S&P 500 moved higher or lower by 1% or more. So if you look back over the last 25 years, it is the top fourth most volatile year. And the other years you can see were 2002, 2008, and 2009. So it was a very volatile year for the stock market. There was also significant disruption. So it was very interesting to see last year, all the tech-based companies really outperformed. Growth was really, really moving forward at a pretty fast pace. So you think of things like internet retailers like Amazon, and you think about things like Apple, more people on their devices buying iPads. You think about things like Google and more people on the internet, and Microsoft, more software usage. So companies like this were really driving last year, and we think a lot of this was trends that were already on their way, but they were expedited. But on the other hand, you see the value side of things. And value are things like energy sector, financial sector, and these did not perform well through the end of the year. Really, even to say that there was a negative year in parts of the stock market. But if you take a smaller segment and you say, well, what happened when the vaccine came around? So late in the year, when the positive vaccine news came out, all of a sudden the value side of the market started coming back. And really, these returns that you're seeing right now are from November 9th through the end of the year. And it was definitely a turn, or what we call a rotation in the market. And vaccines helped investors begin to see a point in the future when the world might reach some kind of new normal, and it wasn't just going to be all of us sitting behind computers. And so you can see this evidenced here. And this is James McIntosh from the Wall Street Journal. Is it finally time to buy back into the shares of the unloved and cheap companies? On Monday, these value stocks beat expensive growth stocks by the widest margin of any single day since the 1930s. The question investors face is whether Monday's extraordinary move marks the end of a grim decade and a half for value, or is just another false dawn amid the gloom. And so I think this is one of the things that we continue to question, but I would mention that diversification is one way to take you out of this guessing game, which we employ. Another area of hot discussion is the S&P 500. And while the value stock question remains unanswered, we do know that valuations for indexes like the S&P have risen to high levels. So this chart shows PE ratios, or price to earning ratios. These ratios compare the current share price to its per share earnings. It's a measure that helps investors understand whether a company or an index is inexpensive, fairly priced, or expensive. And the black line on this chart shows the trailing PE, which is based on the index's last 12 months. And so the blue line is really about where it is going forward and looking at the next 12 months. So that's where you see the differences there. And at the end of the year, they were trending higher and getting more expensive. And we do know that the market is being driven by a lot of those tech stocks, where we're seeing a lot more prices, or a lot higher prices paid for shares of those tech stocks. And when we think about something like the S&P 500, and you look inside the S&P 500 and you think about PEs for individual companies, I think it's important to understand that these different segments don't mean that there's not inexpensive stocks out there, just like there's some very expensive stocks out there. So for example, if you take the top 25 holdings in the S&P 500, and it's probably not a surprise if you watch the news, but Tesla is the most expensive stock in that group, trading at 208 times price to earnings, which the normal market level, or what we call fair value, is somewhere in the 16 to 18 level. The next highest might actually be a surprise to folks, but Disney is the next highest at PE of 105. And then you get companies like JP Morgan, which is at 13, or Bank of America in the financial area. But even some tech stocks like Intel is trading at 12, or Verizon trading at 10. So there are still stocks that appear cheap, but there are certainly stocks that appear expensive. So why did the stock market do so well last year? Well, and you can see what we put on the slide here, and it's really answering the question that we heard lots, which is, if the economy is doing so terrible, why is the stock market doing so well? And well, we had supportive central bank policies. We had government stimulus programs. We had these big 5 disruptive companies in the tech space that were really surging ahead. And the stock market, of course, looks ahead. And then finally, kind of finished there with something that we haven't talked about too much, but did mention briefly that low interest rate environment is typically good because businesses can borrow and continue to grow their companies. So speaking of that low interest rate environment, when you look at here, you can see why investors like stocks so much. The chart shows the 10-year government bonds in various countries. The U.S. Treasury rates were low, and they were below 1%. So again, you give your money to the government, you're going to make less than 1% for the next 10 years. But they actually still look positively generous compared to things like Germany, which were actually negative yields, as you can see by the red line in front of you. So, when you think about that, negative yields, well, that doesn't seem like a very great place to invest your money. And even less than 1% wasn't great. So it was sort of pushing people to take more risk. And that's one reason we believe we saw the stock market go higher. And here's the question that we've been getting. I think I've been getting it almost monthly since 2008, which is, when is the end of the bull market in bonds? And you think about this, people are speculating that this long predicted end of the decades-long bull market in bonds might finally be here. Since bond yields peaked in the early 80s, bond investors have benefited from falling rates and rising values. I would just mention that, it would be nice to have that 1981 bond if you were an investor, though, with the very high interest rates. Because there's this inverse relationship between bond rates and bond values, when rates rise, as may happen in the next couple of years, bond values could fall. So it's important for investors who are relying on bonds to generate income to make sure that they haven't taken on more risk than they should. So if rates start to move higher, the capital invested in the bonds may lose value. And if you're in retirement, obviously that can make you a lot less comfortable if the interest rates that you're receiving locked in low, and then your bond values are going down. So again, this is something we look at when we build our portfolios anyway, but just wanted to mention that. And then what does that lead us to? Why would bond rates go up? Well, because of inflation. And we're getting this question quite often as well. And so one thing that could cause the Fed to rethink its low interest rate stance is that we're starting to see bits and pieces of inflation in the economy. And the premise of low inflation is baked into our policies and our financial markets, as the economist mentioned in December 12th. So if inflation's edging higher a little bit in 2020, despite a severe decline in the energy prices, where did it come from? And so you have to open it up and kind of just look through and say what items really caused this to go up. And this inflation that we saw for 2020, you could think of things like lumber that was up 75%. Well, that's an easy one to see why, because the supply shut down, because plants shut down, because everybody was worried about the virus. And then everybody at home started going crazy, rebuilding their back deck and doing all the projects they wanted to around the house, while the housing bubble was still booming as people were moving out of major metropolitan cities and trying to get into single family homes. So there's a lot of pressure there. I don't know if that's sustainable inflation, and maybe as the economy recovers or vaccines take hold a little bit better, and the health of our country gets a little bit better, we may see some of those pressures of inflation subside. But either way, this is something that we're going to watch, and we're going to continue to watch. Inflation doesn't really sneak up quickly, though. It is something that it can have spikes and drops very quickly, but that's typically not sustainable. So longer term inflationary trends are something that we can watch. And so, again, from the economist here, some of today's inflationistas predict a possibly high but transitory spike in prices as consumer spending bounces back from the pandemic. So economists at Morgan Stanley, where we used to work, fundamental shift in inflation dynamics in America, with inflation rising to the Fed's 2% target by the second half of this year and going on to overshoot it. So there are people who are thinking that we are in the midst of inflation. I would say if you think that's because the government is spending lots of money, or printing money as people like to call it, I would just mention that in 2009, when we bailed out Wall Street as a country, all we heard in my entire industry was that inflation was going to run rampant. Well, here we are 12 years later, waiting for that inflation that was supposedly going to come in 2010, 2009. So, I don't think that we can just look at the academic side of this. I think we have to take into context all the different variables that go into today's economy. And then finally, for last year, my last mention would be we got a lot of comments and questions about the presidential race last year. And there was a lot of fire around it. I mean, people's emotions, and there's a lot that's still out there. But as I put out that presentation right before the election, and as I will restate now, if you invested only when your favorite political party was in office, you'd have missed out on some really significant returns. And so it's wise to keep politics just out of your portfolio. It doesn't matter whether Democrats or Republicans are in charge, whether it's Congress, whether it's the presidential office, whatever it is, the party in power is just one of the many factors that affect performance at the time for investments. And I would just mention this as well. Politics certainly don't change your personal long-term financial goals, or at least I hope not. And so that's what you're investing for, and that's what we build portfolios for. So looking at the economy, looking at the stock market and where we've been, now let's shift our attention and start thinking about where we are today. I started this section where we are talking about working and learning from home. This is certainly something that we are doing now. I've only had one client that's come in the office so far this year for a meeting. Everybody else has been virtual, which is a very different change. We've got students all over that are working school, educating themselves, or their parents are trying to educate them through learning online. And so it's been pretty challenging environment. So we talk about that. And as you see here, I mentioned and coping with it. So we call them the work at home warriors. Folks have shifted to video meetings. They've experimented with all kinds of different things to do with their filters in the background, hearing and sharing unexpected clamor from family members. And fortunately, people are still getting a lot of work done. So we are really coping, as I mentioned earlier. This bottom left picture with two kids and a parrot on his head, it kind of reminds me of our own John Zachary, as his daughter Piper started virtual kindergarten, which is sometimes tough emotionally to hear that said. But, I like to say it this way, as we finish 2020, actually people were bullish on the stock market. This is the individual investor survey. So this is not professional investors or financial advisors, but individual investors. And they kind of use that as a contrarian indicator because typically individual investors a lot of times get it wrong and they chase returns. So 49.1% were bullish. Well, the historic average is about 38. So that gives some context. There's a lot more people who feel that the stock market was going to be good. So we need to be leery of that. Nobel laureate Robert Shiller, who's a famous author amongst other things, mentioned that when interest rates are low and likely to stay there, equities will continue to look attractive, particularly when compared to bonds. So again, an academic perspective of it. But then you see that CFOs weren't quite so optimistic. Deloitte has a CFO signal survey, and with the S&P 500 at that time above 3,500 and continue, 80% thought that the market was overvalued, but 60% still thought it was going to go higher. And so again, one of the folks who runs that program said, I think many CFOs believe that one point in time we'll have a pivot where the capital markets will be more aligned with the real economy. So again, I think we need to see what is real. Are the stock market prices too high? Anticipating a good recovery, not only in the health of our nation, but also in earnings? Or are earnings going to actually run up and make these prices what we would consider fair value? And I think the mix of opinion reflects a very different perspective, but it also reflects the unique circumstances that we're in. The development of effective vaccines provides hope for the future, but we're not there yet. And this is from Liz Ann Saunders, who's the chief investment strategist for Schwab. She says, if vaccines represent the light at the end of the tunnel, the virus means we're still in a fairly dark part of the tunnel. And even now, I think we could still say that here, a little bit over a month into the new year. There's people getting vaccines and we're starting to see that, but the numbers are still very elevated and we're far from being out of the tunnel. But what has happened is this light that is at the end of the tunnel has started this massive market rotation. So we saw growth to value, we saw large to small, so larger companies, smaller companies are doing better. Cyclical businesses are starting to recover where the defensive ones are kind of stale. Stay-at-home companies that have done really well over the last year, we're starting to see out and about companies recover. And things, the leaders are now starting to be laggers. And I don't mean that in the sense of they're going down, but more in the sense that they're not moving up like they were last year. So, I wouldn't say that we're done. Typically, when you see market rotation, it's typically a very bouncy time in the markets. And so, this rough road before we get to the future, it's kind of, and we've identified a few things here just to talk about, which is number one, vaccine delivery challenges. So we're trying to overcome this delivery issue and production capacity and cold storage issues and cold shipping issues. So there's a lot of stuff going on trying to get the vaccine out. Not to mention there's new vaccines and then there's new strands and a lot of the other things that are going on. So, if we don't have significant declines in our numbers, then we think that by the summer, we're going to definitely see some more volatility as we get through the first quarter earnings and into the second quarter earnings. So it's something to be mindful of. There's a lot of focus on just exactly how the health of the pandemic goes from here. Another big one is the long-term unemployment numbers. And so, we need to think about how it hurts the economy. So it lowers the likelihood of finding a job and it increases the likelihood that people will exit the labor force. So if you can't find a job, it's very easy to see that you're going to be forced to make changes. But when you think about a longer term trend, and if people say, well, we've managed to live off of one household income now, and these kind of things, well, you're exiting people from our labor force, which is not good in the long run either. So this can hurt short term, but certainly can hurt long term as well. Small business destruction. One threat to our, not only the unemployment, loss of millions of small businesses, but those small businesses are big employers. So that's more than 47% of U.S. workers are employed by small business. So, small businesses are proving to be resilient though. And I would just mention that there's a good chance we're going to lose a lot of businesses but there's also new businesses coming to market every day. And we've been really pleasantly surprised to see how many new businesses are being started. And so, it's creative destruction is another way of saying that. And we like to see that. We like to see the competitive nature of the marketplace, and we like to see that if one business is doing better than the business that's been around, well, let the new business win. And we want to be invested in the one that's doing all the right things, innovating and staying ahead of what their consumers need. The next area here is the economic relief package. And so, that's certainly a big issue that's going on right now. The last one that was signed into law in late December, it did restore some economic safety and included some relief checks, extended unemployment, but we're still looking more at that and really figuring out where it's going to go with what they're going to put as far as I would call them economic safety nets. But I think at some point we need to see the Band-Aid get ripped off. It's a hard way to think about it, but it really is. We need to see which companies are actually not going to come back and make the opportunity available for the new companies that want to get started. We can't keep non-competitive businesses alive in the long run, because that's not fair to the businesses that try to get started. And so it's a really interesting dynamic that we're in. We don't want to hurt ourselves too bad, but at the same point, we need the pain to see what's going on in the economy without government stimulus. So that'll probably happen over the next year. That's something we're watching closely. Now, a little bit of inspiration here. In a year when so many have needed so much, Americans stepped up their giving, which is what I love about America. It wasn't easy to know where to give, though. And you could see someone from the NASDAQ wrote this: in a year like 2020, choosing where to direct your dollars is like picking your favorite child. Should your money go towards nonprofits providing basic needs, organizations fighting for social justice, or a campaign to help local businesses stay afloat? And I think, that just tells you there was a lot of need in 2020, but it's just really beautiful to see how folks ended up giving. And if you look at this, I just kind of show it in this terms as well too. Charitable giving increased by 7.5% year over year in 2020. That was really incredible. And then grants from donor advised funds were far higher. And so donor advised funds are something that we offer. What they are is you put money in, you get a deduction, but then you choose when you want to donate, which could be 2-3 years down the road. And luckily last year we saw that people actually started giving the money out of their donor advised funds, which is a really strong thing to be proud about. So that's kind of where we are today. So let's now shift gears and talk about where we may be going. Reconfigurations of work and learning have caused many of us to reevaluate how we spend our time. Many have discovered that time is a precious commodity, especially when you're working from home and you have children or pets running around, and they've been thinking about how to spend time more effectively. So as we think about our time, we want to really think about that time is money. And here's the old Ben Franklin quote: "He that can earn 10 shillings a day by his labor and goes abroad, or sits idle one half of that day, though he spends but 6 pence during his diversion or idleness, it ought not to be reckoned the only expense. He hath really spent or thrown away 5 shillings besides." And so again, we value our non-work time, but how much is that actually worth? And I think that this is an important dynamic where we are currently trying to think about growing our economy and recovering. So how much is it worth in this free time? And I think, when you think about salaries and wages, well, that's pretty obvious. Here's how much our employers think about us. And that's also supposed to be reflected in the prices that we're paying for our goods and services, our investments, our productivity, our economic growth. But how much is our non-work time worth? And so here's the DOT. They put significant amount of time trying to determine how much it's worth, because it helps them decide where to spend tax dollars, because you think about travel and being stuck in commuting. So in 2016, the report valued local personal travel at 50% of hourly income. So that was about $13.60 an hour. In 2020, University of Chicago economists teamed up to measure the value of time by determining how much people are willing to pay to spend less time waiting for their rides. So they set the value of our time at $19 an hour. And of course, during rush hour or rainstorms, or certainly if there was a snowstorm, the value of not waiting increases even higher, and in this situation by about 50%. So I think it is important to think about our free time and what that's worth, and what's the best way to utilize our time and how do we do it more effectively. So what's ahead? Well, this is a pretty interesting thing to think about as well. So these were trends that began last year, and we believe they're all likely to continue into 2021 and beyond. So the work from home housing boom. Working from home meant spending more time at home, and many found they did not have enough space. That sparked the current boom in the housing market. So we're seeing a lot of trends, particularly coming out of major metropolitan cities. Americans are saving more than ever, which I think is, I mentioned the unemployment, which is hard to consider here, but it's on an absolute basis. We are saving more than we ever have as Americans. It's possible that this will change when there are more ways to spend their money, of course, but it's pretty impressive to see that we are valuing savings more. This next one, sustain innovation and technology adoption. So during 2020, companies had to innovate to survive. We did it here at Pathfinder. We hope innovation will continue and anticipate that technology will play a more significant role in all aspects of our life: education, health, cities, buildings, everywhere, really in the economy. The demand for cleaner energy in cars. So we're starting to see a push for that, both from the consumer and also from policy. So the energy sector, renewables experienced a setback in 2020. However, governments in the US and around the world are setting new rules that favor these electric vehicles, I should say. And for example, give you some numbers. Japan has set a deadline for 2030. California has a deadline of 2035, and France has a deadline of 2040. So we anticipate these trend towards clean energy will start being driven by consumer demand as well too, which we're already seeing. And then finally, of course, 2020 was a big year in our country in particular, but this pursuit of social justice. In December, the NASDAQ exchange announced plans to require the more than 3,000 companies that are listed on the NASDAQ to improve their boardroom diversity by having 2 diverse directors. It's a change that could really benefit investors because studies have shown that boards that have women on company boards result in better acquisition and investment decisions, and they're less aggressive risk-taking. So both of these are sort of examples of delivering benefit for the shareholders. So it's pretty interesting trends that are out there that we do believe will continue. So what do we think is going to happen out there? And so let's look at this 2021 economic growth outlook. When you look at it, the world is supposed to have about a 5.2% increase in GDP annual change. Well, again, you have to think that that's over a pretty miserable year. So it may not be as impressive as you first think. But it's still quite impressive to think that less than a year ago, we were really starting this pandemic. And you can see the US here at 3.1 in the 4th column over. World economies rarely move in lockstep. In fact, a synchronous global recovery where growth in both developed and emerging markets accelerate in the same year, has happened only a dozen times over the past 40 years. The last in 2017. The stage could be set for another such sync beginning in the second quarter of 2021. So this is from Morgan Stanley Research again. And I think it's important for us to keep an eye on that. So we talk on one hand about the price of stocks, but on the other hand, we talk about synchronous global recovery. And why do we think about it globally? Well, there's certainly been a change in the leadership in our country. And one of the things we're looking at is the free trade agreements that are out there. I think it's important that when you have trade agreements, and there were several that were launched in 2020, they help some nations grow quickly. So in November, for example, 10 members of the Association of Southeast Asian Nations and 5 regional partners signed the Regional Comprehensive Economic Partnership. The Economist reports that it's now the world's largest plurilateral trade agreement. Again, the world's largest. And so some of these RCEP members, which you see there on the left, are also participate in the Comprehensive and Progressive Agreement for the Trans-Pacific Partnership. So the RCEP, the one on the left there, they connect 30% of the world's people and output. That's pretty impressive. And they're members now of these other ones. And so there's a thought from The Economist and others that global GDP will be increased simply because of these trade agreements by the tune of about $186 billion. And so Right now, we're seeing how our trade agreements go. The U.S. isn't participating in either one of those right now, but there is definitely talks about joining there. So we'll see what comes about that. And there's certainly a lot of risks out there looking forward. I mentioned these, but vaccine effectiveness. Will they be as effective as expected, and with the possible mutations and variations? What is our pace of recovery? How quickly will the economy bounce back? Will people find work, or will it take a while even if the economy is recovering? And I don't think the U.S.-China tensions are going away. We had very high tensions between us from a trade standpoint, and even though we've changed presidents, we do believe this relationship will remain contentious. Biden is no more a fan of China than Trump was. Probably a little less noisy about it, but neither one of the presidents feel that we want China to continue to dominate our trade. So that's going to be an interesting relationship that's going to remain, pretty hot going forward. Consumer habits, really, and behaviors. Will new habits consumers have formed during last year, during the pandemic stuff, as far as businesses and business models continue? So will you keep ordering groceries online? Will we all keep working from home? Will we not take the bus if we live in a big city and things like that? So, there's a lot of questions about consumer habits that are still going to be answered as the health of our nation returns. And then finally, what's our investor behavior going to be like? We have been getting more ambitious. There's a lot of stuff going on out there. In particular, you heard about GameStop, which I'll put out a little bit on that in a week or so. More trading in investing has inherent risks, but the risk of the activity changes based on how people around you are behaving. So again, we need to look at all of this as well. There's nothing new in the trading world. But I'll mention that a little bit. So, how will we act as investors as these risks unfold and as the economy continues to improve, and what are going to be the facts that we're looking for? I'd be remiss if I didn't talk about this next one, because we get this question a lot. We've got so much debt. What's going to happen to economic growth? And realistically, it's a significant risk. We have extraordinarily high national debt. We have to spend now to get out of the crisis. But knowing when to stop spending and figuring out how to reduce the debt is not going to be easy. And it's typically going to take a very, very long time. And you can see the trend lines there. Really there's only been one downward movement in the last 40 years, which is in the late 90s. But other than that, we've been in pretty much an uptrend as far as debt goes. So it will impact economic growth at some time. And it has been proven the ratio is particularly effective at knowing what we're going to do when public debt exceeds 90% of GDP. And that's where we are today, and it does hamper growth to the tune of about 50%. So, you think about repaying this debt, and how can we continue to grow if we have to repay our debt? And that's the simple way of saying that, well, we have to give up growth in order to do that. But at the same point, we need growth in order to pay it back at all, or we're just going to continue to raise our national debt. Another thing I wanted to mention here is Jim Rogers is the founder of the Quantum Fund, and thinking about the national debt, he mentioned as a serious concern here. A year ago at this time, America was the largest debtor nation in the history of the world. That debt is now up by trillions of dollars. That's trillions with a T. Someday we're all going to look back 3 years from now, 8 years from now, and say, wait a minute. What was all this debt about? What are we going to do now? And I think that really sums up, the situation that we find ourselves in, is that we pumped up a lot of debt to try to bail our economy out. Whether or not we need it or not is to be seen. And it's always easy to look back instead of looking forward or looking in the here and now and make these tough decisions. And then finally, sort of looking forward, I do want to make sure that there are some things that we need to look at now. So, we need to look at our legacy plans and thinking about things like this. The Secure Act changed the rules for stretch IRAs. And so you cannot stretch IRAs anymore across generations. And so depending on what you had planned, we'll take a look at this. Roth conversions are attractive when rates are low. So, if we think tax rates are going up, we need to look at that. And of course, how you are personally affected by taxes is going to be an interesting one. I've seen the shooting the proposals. We'll see what actually gets passed. But if you're above 400,000 in income, you're going to be particularly vulnerable to some of the planned policies if they become law. If you're under that 400,000, I don't think you're going to really see much of an impact based on the current proposals. And I think that that's important to know, because I think that increases the likelihood that it will get passed. So if only folks 400,000 up are affected, then there's much more likelihood that you'll have a rally around the ability for the other folks to not have tax increases, and in some situations actually decreasing taxes. And then the last one is the COVID-19. So it's going to continue to be a threat, particularly to older Americans. And we've got to see how the immunizations go, and we really need to know how this all going to unfold, and particularly with these new mutations. So lots of stuff to still watch, and lots of things to continue to be mindful of. So with that said, that's kind of what we're looking at in the future. But let's take a look at what some of the experts are saying. So what are the experts saying right now? Well, let's take a look from investor and philanthropist Stanley Druckenmiller, who's from CNBC Squawk Box interview back in September. I have no clue where the market's going to go in the near term. I don't know whether it's going to go up by 10. I don't know what's going to go down by 10. But I would say the next 3 to 5 years are going to be very, very challenging. I think that's a good tone to sort of set what the experts saying section here, which is no one really can predict the future. And in the next 3 to 5 years should be challenging. I don't know that they will be more challenging than the last 3 years. If you remember, we had a 20% correction, almost 20% correction at the end of 2018. And then, less than 2 years later, we had COVID. And so we've had some significant challenges in the last 3 years. But, as usual, we expect challenges going forward. We just don't know what they're going to be. Well, let's take a look at The Economist here from November 28th. COVID-19 has brought with it economic damage on a vast scale. Yet the rapid changes that have been forced on many industries are leading to innovation that will outlive the pandemic. And in some cases, they're leaving the incumbents less mighty than before. So that's kind of an interesting perspective of it. And I think it's important to note, again, forced innovation is a pretty interesting dynamic to consider. And then, Stephanie Kelton here from the economics and public policy professor with the Barron's article in December 4th said, how we work is definitely changing. That could have long-term disruptive effects to air travel, commercial real estate, downtown restaurants, and such things. We also know we're going to lose potentially half of all small businesses. That's going to have a big impact on everything from corporate concentration to the makeup of local communities. And I mentioned that a little bit earlier, and I think it's important. It's not that we're not going to lose businesses, it's how many new businesses are going to be created. And that's one that we are carefully keeping our eye on. Beschloss, who's the founder and CEO of the Rock Creek Group, which is a sustainable investing firm, told Barron's in December, climate. It is going to be huge in terms of investments. The private sector is going to lead. Companies are moving towards clean energy because they know it's not just regulation, it's their consumers that are starting to demanding it. So I think that's an opportunity when we kind of look out as well too. Now, obviously he's going to be biased because that's the type of investing he does, but it's certainly something that we're seeing. And then again, I'll bring up Liz Ann Saunders, who's the chief investment strategist for Schwab. She said, whenever the market is trading at or near all-time highs, it's important to assess the risks. Sentiment remains a key risk, especially given the economy remains inside this tunnel she mentioned. Even if vaccines represent this light at the end of the tunnel, investors should remain disciplined, diversified, and opportunistic with regard to rebalancing, which we've been doing. And you've seen that in the accounts this past year. And we rebalance once so far in 2021, and we'll continue to look for opportunities. I think it's also important to note that the way that we treat your portfolio is the way that we look at your life, which is simply, we're here to serve you. No one knows exactly what the future will bring. We can position portfolios to avoid unnecessary risks, which is what we do. We spent a lot of time today talking about the global economies and the financial markets, but it's just as important for us to know how your lives may be changing throughout the coming year. And you think of the big things, somebody getting married, are their children, are their grandchildren, are you switching a job, are you retiring, or is there a health issue? So, these are things that impact your here and now. I hear a lot from our retirees that, we haven't been able to spend the kind of money that we wanted to last year. Well, I hope you do. And I think about the folks that are working that are, they can't keep their head above water if they've got a couple kids and they're trying to homeschool and they're trying to keep their job. And so there's a lot of stuff going on out there. And so I just want to mention that we are here for you. And I'll close with a slide here that says, this is the only 2021 in your lifetime. And so I think it's important to keep that in perspective. 2020, we certainly had to sit on our hands for a bit and hunker down. And I'm not telling you to run out and go do anything crazy, but I am telling you that you need to make the most of 2021 for yourself. Because this is the only one we're going to get. We have to deal with the situation that we're in. And we hope everyone remains healthy, and we are certainly here for you. And so with that, thank you for listening to the 2021 Investment Outlook. We will continue to monitor your financial plans and also your portfolios, and we are here for you no matter what you need. Thank you for listening.